Overleveraged hedge funds are destroying public pensions, and over $3 trillion has already been lost. Today I want to talk about the impact of these overleveraged hedge funds on the overall market and what's likely to happen to them during the current market crash and during the current recession. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Unusual Whales tweeted saying the California Public Employees Retirement System, Calpers, the $442 billion pension fund, has lost $60 billion so far this year. This screenshot from the Calpers website says Calpers is the largest public pension system in the United States. The system's investment target for the year was a 6.8% gain. And it also says that falling short means California state and local governments will have to make up the loss with money that otherwise might have been spent on roads, parks, and other budget items. Alternatively, this pension system may have to go without, and potentially millions of Americans may end up losing their savings. So as a quick calculation, a $60 billion loss on a $442 billion pension fund is around a 15-14% loss so far for the year. A predicted 6.8% gain means they're currently below their target by around 20% in only around half a year. I also want to bear in mind that retirement systems are supposed to invest in incredibly safe investments, real estate, AAA rated commercial paper, and government bonds that don't default. But more and more, these retirement systems or these pension systems are investing into over-leveraged, risky hedge funds that are blowing up, and they are taking the retirement money alongside. Instead of these retirement systems investing into AAA rated commercial paper that may provide a gain of between 2 and 8% per year, but will not suffer any losses, instead they're going leveraged YOLO long into stocks like Tesla at the very tippy top. These retirement systems are investing massive chunks of their portfolio into over-leveraged hedge funds that are investing on a leveraged basis into risky tech stocks. These hedge funds are then blowing up, losing 20, 30, 40, 50, 60% of their portfolio in a single year, and they're saying, sorry guys, we tried our best. But at the end of the day, that's hundreds of millions, potentially even billions, even trillions of dollars that are being lost from public pension schemes around the US. As Mark says, the SEC has made videos targeting dumb money and meme stocks, while smart money is out here destroying people's pension funds. He said, now we know who truly needs to be educated on how to invest and how not to take risky, over-leveraged bets on a crashing market. And as this article from CBS says, the stock market's fall has wiped out $3 trillion in retirement savings this year. This is the US stock market rout that has put US equities into a bear market, isn't just reducing the net worth of billionaires like Elon Musk and Jeff Bezos, it's also taking a toll on Americans' retirement savings, wiping out trillions of dollars in value. The sell-off has erased nearly $3 trillion from US retirement accounts. By her calculations, 401ks have lost around $1.4 trillion from their accounts since the end of 2021. And people with IRAs have lost $2 trillion this year on top of that. And it says data shared by Morningstar show that most popular target date funds, mutual funds that hold a range of investments that automatically adjust according to a target retirement date, have lost between 10% and 22% of their assets under management this year. Now again, these mutual funds holding a range of investments should be more heavily biased towards safer investments, and they shouldn't be taking on losses like 22% AUM losses per year. If these mutual funds are only making say 2 to 10% profits per year, they should only be taking a max drawdown of say 1 to 5% per year, not a 22% loss in a single year or even in half a year. And on top of that, it's not just US retirement systems feeling the pinch, the exact same thing is being felt over in the UK as well. Bloomberg says that UK lawmakers have slammed the FCA, saying the market regulator failed to protect British Steel pension scheme members who lost their life savings from unscrupulous financial advisors. Now over in the UK we call it a pension scheme, obviously in the US you call it a pension system or a pension fund, but I think they're all effectively interchangeable. Now annoyingly the article is behind a paywall, but it basically talks about these financial advisors and these hedge funds advising these pension systems to take riskier and riskier investments. But now employees of British Steel have lost their entire life savings as a result of this dodgy advice. And I briefly touched on this yesterday, but as Cat Striker followed up, she said BlackRock lost $1.7 trillion of client money. Now don't forget, BlackRock invests massively on behalf of retirement systems or pension funds. A massive amount of pension funds invest directly with BlackRock and expect their money to be safe and expect it to grow slowly. But instead, BlackRock has lost $1.7 trillion of client money, aka $1.7 trillion of potential pension money in the last few months. And this screenshot says that BlackRock just chalked up the record for the largest amount of money lost by a single firm over a 6-month period. Bloomberg says that BlackRock is obviously breaking the wrong kind of record and is setting the record for the biggest losses. And we're also seeing both Google and GitHub freezing hiring effective immediately. Everyone in the hiring pipeline is impacted. It says GitHub is doing it because of economic conditions and Google is likely doing it for the same reasons as well. He says big tech hiring is freezing up incredibly fast. George also followed up with this chart as well, showing the slowdowns and freezes in big tech. Apple is slowing down hiring, Google is also slowing down as well, Facebook has frozen, Netflix is slowing down hiring, Twitter is frozen as well, Tesla and Oracle both slowing down, and VMware has frozen as well. That is tons of not just small tech startups or small crypto startups freezing their hiring, but even big tech, even the largest of big tech, is also freezing and slowing down hiring as well. Clearly they know the recession is coming and they know the stock market is going to suffer bigger and bigger losses, and that's why they are reducing expenditure and they have frozen hiring. But again, this just doesn't bode well for these pension funds, as they're likely to lose more and more money as they're still invested into these over-leveraged hedge funds. Altcoin Hub also tweeted saying blockchain.com, the exchange platform, also cut 25% of its staff amid a bear market. The company said it was closing its office in Argentina, suspending hiring in the US and in the UK, and cutting staff and top managers' salaries. And as Bitfinex said, crypto exchanges are supposed to make money from crypto trades. The price going up or down shouldn't cause any stress on honest crypto exchanges. And he said, so when crypto exchanges are shutting down withdrawals or freezing hiring and cutting costs, that tells you they were gambling with customers' crypto balances. He said it's like a casino that takes the money you give them for the chips and then uses that money to play at another casino. They somehow forget the house always wins, but in crypto those casinos also go to other casinos to gamble, and so on and so forth. And that's why all of these crypto exchanges are in such trouble right now, because they have been using their money, their customer money, to invest in other crypto exchanges and to trade crypto elsewhere as well. All of this money is effectively going around and around in circles, but at the end of the day, the house always wins. And when the crypto market crashes like it is doing right now, all of these exchanges are being caught out. And that's why more and more over-leveraged crypto exchanges and over-leveraged hedge funds are losing money at an incredible rate, and they are closing down, being liquidated and going bankrupt. As more and more of these over-leveraged hedge funds and exchanges do go bankrupt, they're forced to sell off their long positions, and it pushes the price down not only in the crypto market, but in the stock market as well. And obviously as the stock market continues to fall, it brings more and more funds closer to that liquidation point, and it's effectively a self-fulfilling prophecy. As more funds get liquidated, the market falls further, causing more funds to be liquidated. And ultimately that brings us closer and closer to the AMC squeeze, because we know that when all of these over-leveraged hedge funds are liquidated and they're forced to sell off their long positions and forced to cover and close out of their shorts, they'll be forced to buy back hundreds of millions, if not billions, of AMC shares, causing the squeeze. And finally, you may have seen this tweet from Kohrs yesterday saying that AMC repurchased $72.5 million of its 10% second lien subordinated secured notes due 2026 through the open market for approximately $50 million, representing a 31% discount to the face value of the debt. So not only has AMC got a 31% discount, aka saved $22.5 million worth of repayments, they now also no longer have to pay interest on this debt for the next 4 years. This is $7.25 million worth of interest on a yearly basis AMC is now saving, and an additional $22.5 million saved on top of that. Now you may say, Tom, that's only a small portion of AMC's debt, which is true, but it just shows AMC actually has a stockpile of free cash at the moment, and they're trying to use it in the most strategic way possible. AMC is effectively using their stockpile of cash to invest in the most effective and the most efficient ways of saving or making more money. And Freedom Fighter also tweeted saying, I don't believe in coincidences. He pulled up this tweet from Adam Aaron and this tweet from AMC Theatres as well. Adam Aaron tweeted saying how the Q2 earnings are to be announced on Thursday the 4th of August. And AMC tweeted saying they all squeezed on August 5th. Now obviously August 5th is one day after the earnings are released on the 4th of August, and therefore maybe this is AMC and Adam Aaron hinting the squeeze or the pounce will occur the day after the earnings. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.